As David has laid out, Catholic nonprofits find themselves in a vulnerable position given today's societal dynamics. There's more focus and scrutiny being paid, and some of that focus, as David quite rightly pointed out, is adversarial in nature. Not only against the mission, but obviously any large pile of capital is always attracts excess interest. This requires that we be vigilant and focused on avoiding footfalls, missteps that may be innocent in nature, but open up your entire organization to the time-consuming scrutiny, or worse, potential liability and potential personal liability. These things could also disrupt or impede the humanitarian mission of your organization. Now, there are three key steps. One is a disciplined preparation. Two is a diligent focus on the duties that are required of you. And three is adopting the industry best practices, because if it's out there and widely adopted in a situation of potential negligence, they certainly will use that as a comparison against you. You want to ensure that your time and efforts can be fully devoted to your Catholic mission and not sidetracked by these other issues. Now, my segment reviews selected. We certainly can't cover everything, but selected governance principles. I've got a number of cautions against shortcuts that you might be tempted to take, and I'll also provide you a list of sort of recommended actions, sort of micro actions that will help ensure that you and your organization's effectiveness as to meeting or exceeding the required fiduciary standards. We are all familiar with the big three, the fundamental duties of care, loyalty, and obedience. We'd like to layer in a couple of other considerations as well. One would be the prudent investor rule. Number two is UPMIFA. The third would be the business judgment rule. Fourth is piercing the corporate veil and related concepts. It's something that David mentioned in the first segment. Now, the duty of care is employing the proper review, time, and expertise to protect the best interests of your organization. If you lack this required expertise, you must hire it or alternatively outsource it. The duty of loyalty means that you put the interests of the organization first, not equal to another goal. All other interests should be left outside the boardroom. Undivided loyalty is really the term of art. So no self-dealing, no excess business holdings. As far as apparent conflicts of interest, they must be bubbled up, they must be disclosed, and you must deliberate about them and memorialize that in order to protect the institution. Obviously, no actual conflicts of interest should be allowed. You should also guard against captive, or what I would call forever vendors. Every 5 years or so, virtually all your vendor contracts, including outside counsel, for example, and certainly your auditor, should be rebid. It is simply good discipline, and it combats complacency. And it ensures that you're current with what's available in the marketplace. We've all seen, as Chris mentioned, this dramatic diminution of fees charged in the investment arena over the last 5 years. And similar things have been happening in other service providers. Moreover, and this is very important if you have some special skills, if you possess a skill evidenced by a CPA, a JD, or other professional certification, then any action taken by the committee or the board in your area of expertise, assuming you're a board member, will be held to a higher standard of review, and violations or negligence in your subject matter specialty will receive focused scrutiny. So, for example, if you're a CPA on an audit committee, you may be able to not pay too much attention to a minor situation having nothing to do with accounting. But if you're a CPA on an audit committee, you are potentially the most liable member. Now, the duty of obedience means adhering both to the letter and the spirit of the applicable laws. And fortunately, most of the laws are typically state and federal. Oftentimes, there are not many municipal laws that you have to be focused on. It mandates the filing of required reports and adequate disclosures. It also means properly writing and following your own bylaws. This is one of the easiest ways that people trip up and cause very large problems. If your bylaws do not allow proxy voting, then do not make exceptions. If you require 3 days notice in your bylaws for a special meeting, do not call a next day meeting, because that will potentially put in jeopardy any substantive decision that you arrive at or motions that are adopted. Remember that an investment committee with non-board members on it is actually a committee of the corporation, not of the board. That investment committee cannot bind the corporation. Think of it as ultra vires. This is the legal concept that they lack the requisite authority. Of course they can, and they're designed to make recommendations, both pros and cons, et cetera, to the full board, which then can approve or refer it back to the investment committee for a change. Full stop. The next topic is UPMIFA. It requires some very specific analysis for investment portfolios. There are 7 items in particular, including a survey of the economic environment, inflation, deflation. It's the law of the land in 49 states, and for those interested, it has not been adopted in Pennsylvania or Puerto Rico. I don't know the answer why. In New York, it's Chapter 490 of the Charities Law, and it covers 13 pages. It's available on the Charities Bureau website, okay, which is fine. It's a nice thing to reference in New York. But what is quite helpful and actually user-friendly is the New York department came up with a 17-page primer on how to apply the law on the website. And that's quite helpful, and I would recommend that to you. One of the other aspects of the law is it freed up underwater endowments. Prior to the law, if you went below your original donation amount, you could not spend further. For example, if the market was down 40%. But critically, it also embraced and provided some guidance on the outsourcing of investment functions or activities as needed. And that was quite helpful for the entire investment industry. The next concept is the concept of the prudent investor. And the prudent investor answers the query of what would a similarly situated investor with the requisite knowledge and experience have done. So you're going to be compared essentially to the prudent man standard. Now, the business judgment rule is a very important rule, and it's very helpful for corporations and for board members. It effectively inoculates you if it gives you a good faith assumption for your board's action. They know that you're not always going to make the most optimal decision, but it gives you the benefit of the doubt. But it only protects you if you follow the requirements of the rule. So you have a duty to be informed, to discuss decisions, and to provide the context for your decision-making. Contemporaneous documentation is key. If you don't maintain contemporaneous documentation, it's going to be assumed that there was no documentation and that you did not follow the appropriate procedures, and you potentially can lose that defense. For those of you who also manage pension and insurance pools, there's an entirely additive framework of laws and regulations, including ERISA, the pension, PBGC, as well as state insurance regulatory schema. Now let's address a very interesting topic, and one that David alluded to in the first section, and that is the concept of piercing the corporate veil, which is critically important. You may think you are completely independent, but if you have a sizable corpus, the people will work very diligently, especially plaintiffs' bar, to see if there isn't a way to get at that corpus. You want to preserve your limited liability and avoid personal liability. Errors and omissions insurance can provide coverage, but they often come with large deductibles, sometimes in the range even of $250,000 or $500,000. And I've had to buy some of those when I was heading a foundation. Courts are often reluctant to pierce the corporate veil, but given serious misconduct, especially fraud, they are much more receptive to a litigant's challenge. So let's look at the hierarchy of fact patterns that would be explored, and it's something that David mentioned. If your foundation and another organization share a majority of the same board members, the same individuals, that is a major hurdle. That's a potential major issue in claiming that you are two separate organizations. Moreover, if the person who is the member of the organization, because you can have non-member as well as member organizations. But if that person is the sole member of one organization and it is the chair of the other organization, that's also a very major potential issue. Sharing of bank accounts is also a no-no. Co-location of offices can be problematic. It gives the veneer that there is a joint operation going on. Shared staff is a little bit more defensible as long as you have a detailed service level agreement between the two entities and you actually adhere to it and monitor the hours and the transfer of monies. Using the same phones and email domain potentially could be problematical, depends on the exact fact pattern. If you allow any daylight for a potential litigant, you could be facing months of discovery and depositions, or I'll call it harassment, even if you eventually prevail. So let me give you a quick story from last year. A friend of mine ran for U.S. Congress. He lost, but that's beside the point. But every day, someone would call his New Jersey Assembly office trying to donate to his U.S. congressional campaign. He trained his staff to give the response, "No, we cannot accept any donations at this office. Please call this campaign number. Thank you," and they would hang up the phone. If you accept one credit card number, a one-time donation at the New Jersey Legislative Office, you would be using public or government property for the benefit of your campaign. We can all guess how many nanoseconds would go past before it would be reported everywhere. As I mentioned, a call would come in every day during the campaign. In your own situation, you need to exercise a similar vigilance and train your staff to ensure that the outside world views the organizations as separate and distinct. Now, moving on to Section 2, I want to give you a brief list of cautions against some of the shortcuts that nonprofit organizations are apt to make, I would say penny wise and pound foolish, when they're starting up, ramping up, or changing their goals or mission. And some of the practices cautioned against is the very simple one of borrowing bylaws. They seem to be so tedious to do, why not just borrow somebody else's? I would submit a cancer foundation in State A is quite different from a Catholic foundation in State B. There are different legal regimes, different disclosures, and obviously a religious organization oftentimes is exempt from a 9-9 filing, whereas that typically is not the case with a secular cancer foundation. Copying employee manuals, that's also another cautionary tale. Each state has specific employment laws, and idiosyncrasies exist that could cost you money or put you in a vulnerable legal position. These differences often relate to process requirements for disclosure and notice. Just think in terms of a footfall. By all means, you need to have an employee manual, and anyone out there on the call, if you don't have an existing one or an updated one, you need to get one soon, properly created to protect your organization. This is especially going to be important in cases, David talked about actually grading your employees and keeping track of that. But in the case of termination, you need to make sure that all your T's are crossed and I's are dotted. Another bad practice is mimicking or copying the investment strategies of other organizations. Your return goals, your risk tolerance, your liquidity needs are all different. The risk tolerance includes your estimated maximum drawdown in portfolio value for a given time period or fiscal year that would still enable you to fulfill your mission. Nonprofits also often compare themselves to misleading benchmarks, simply because some benchmarks are so widely distributed. Self-reported numbers are often not even GIPS compliance. I would point out return numbers are also silent as to asset allocation, and you don't know how much risk was taken in order to accomplish that return. Even if you were to embrace a peer comparison, the participants and methodology often change, sometimes even annually, and a peer cohort, as we all know, can be managed to a particular outcome. We've done any amount of research in the investment space, and if you go on our website, you will find it under Foundation Briefs. But one I'll point out in particular, a Georgetown and NYU professor examined 28,000 nonprofits. And the bottom line was that the self-reported numbers were dramatically better than the ones that were obtainable by looking at the IRS filings. So it's a very good underlying research piece, and we provided 4 or 5 pages of analysis as far as where the professors could even improve that analysis. This one is a just asking for trouble, but it's accepting another's due diligence as your own. My buddy at XYZ Foundation checked out this investment fund for me, equity long short. Certainly, you can seek validation for work that you have done independently, but it cannot be a substitute for doing your own diligence. You would certainly be cited for a lack of duty of care, if nothing else. The other thing is not doing detailed documentation of your processes. Even if you do the right thing, unless it's timely documented, it's not going to carry much weight. So in summary, the key takeaways are as follows. You should have a key transaction list, which lists your legal duties and the analysis of the investment proposal and how they marry with the duties of care, loyalty, obedience of MIFA. It's a bit of a check sheet to ensure that you have a defensible position for all the things that you were doing, all the transactions you're undertaking. As far as your process review, you should do an annual review of processes to ensure that they still cover all the situations that you're encountering. From my time, I would say last century at this point, I led the valuation of operational risk at Merrill Lynch banks. And never once did I go through an annual trade or approval process review where the actual manual reflected the current process. There's an all too human tendency to take shortcuts, and the processes tends to evolve on its own. Okay. Fiduciary levels can also be elevated. Each entity is different, even if they are part of the same affinity or religious group. Returns, compensation, rankings are all interesting topics, but ultimately our goals should be threefold. The long-term resiliency of the organization, its fidelity to its mission, and adherence to its required fiduciary duties. These are the most critical metrics. And I would add, once again, be mindful. If you've got a CFA, CPA, JD, etc., that'll be the metric by which you're going to be judged, and you're going to have to ensure that your behavior and comportment and process that you use matches that higher level of scrutiny. So at this point, I'd like to say thank you for your attention, and I'm going to...
You've just heard from Tom Donahoe, practice leader at Manager Analysis Services. The foundation briefs are viewable at manageranalysis.com, Foundation Briefs.